Welcome to yet another session of the MultiMillionaire Forum. We meet every Saturday. This particular month of November, it was Diwali, so which is why we couldn't do the first Saturday, and therefore we're on the second one. But wishing all our YouTube viewers and everyone else who's coming here, wish you a great summer. We hope you have a great financial year. Hope you have a great prosperous year, health-wise, wealth-wise, and in every other form that you're aiming to have this year. Maybe your goals should also get materialized. Maybe you'll have new goals this year. So whatever it is, we wish the best, and we wish that we can also play a role in making all of that happen. So that said, we're talking about a very, very new subject. It is not new internationally, but it is new from our point of view. There has been a lot of activity in this space, and this activity is basically known as factor investing. And factor it's a very scientific, a very complex something sort of a word, But if you think about it, it's not so complicated also after all, because what factor does is there are different factors that determine how the stock market moves. For example, one factor that determines how a stock price moves is the price earnings ratio. Another factor that decides how the price will move is the sales, profit growth. These are some balance sheet metrics, right? What happens is there are statistical metrics also, things like alpha and beta. You may have heard of that before. So what happens is collectively we call all of these different financial terms as factors, okay? And then these factors actually are used to make a basket of portfolio, and this basket of portfolio then is what we invest in, and that is very simply put known as a factor investing strategy. If I had to go one level higher, okay, to define it even more prudently, what would happen is that a particular fund manager, we are very well used to mutual funds, right? So mutual fund, as you know, is done by a fund manager. So there is a team of fund managers, one leading fund manager, and then another couple of people who are part of his team, who they are managing our investments in a mutual fund scenario or in a PMS scenario also, quite similar. So what happens is here, again, there is somebody, not the fund manager, maybe the fund manager can recommend, but there is somebody at the exchange level. We have two exchange, right? Bombay Stock Exchange and National Stock Exchange. So somebody at the exchange creates a basket. When the exchange creates a basket, then they say that this basket has been created on the basis of A, B, C, D metrics or factors. And now the fund managers will create a index around it, or will create a mutual fund around it and give us a vehicle to invest. A very, very fascinating concept. So just stay tuned. We'll go through all the little steps of this. And as we move along, you'll quite enjoy what we are going to do in this factor investing strategy. So we are launching it, so to say, but launching it in the sense in our platform, talking to our group of people. As usual, standard disclaimer that this is all educational purpose only. We will not recommend any name of any company or any mutual fund per se, but we can discuss as we please in the Q&A session, the formal session. We will only stick to our educational purpose and stay with that. So here is factor investing, okay, for all your reference. Okay, please move. Yeah, so you see, there are some very prevalent factors or popular factors, let me call it, and these are like categorized in some sort of groups, okay? Stay with me, it may not be clear right at the beginning, but as we move on, things will become a little more clear. So, for example, you may have heard about, things such as the return on equity or the dividend yield. Now, these are things that you are well versed with, things that you have heard in the past. You know these things. You know what the return on capital employed means. Maybe you don't know the formal definition of that, but at least what you know is that there is a financial term called the return on equity. It's basically, just for sake of completion, is basically how your capital is getting used by the company and what return are you getting on your shareholders' capital. So that is the formal definition of it. But having said that, let's sort of go into each one of this a little bit in detail. So, for example, what happens in a momentum? So, in a momentum, the stock that has been rising, or the group of companies that have been rising for the last 6 months or 12 months. Why are they rising? Maybe there is something happening. Maybe there is something interesting going on about these companies, and which is why they are rising. Maybe there is a fair amount of interest coming in from various institutions and various various players, domestic institutions, retail participation. So because of that, the stock price is moving up like really fast and really quick. Okay, so that's momentum for you. When we talk about a factor called value, that means you are looking at stocks that are relatively undervalued versus their growth potential. So we know that the profit, for example, of a company is growing at 30%, but this stock is right now growing at 15%, which means there is scope, there is value for it to move on. Then quality obviously means, this is a very, very fundamentally strong company. Everything is good. Balance sheet is absolutely intact. Debt equity ratio is so much in control. The company doesn't have too many loans, therefore the interest cost is low. So these are all sorts of financial hygiene sort of factors where most of the check boxes are getting ticked, and that is quality for you. Then what happens is statisticians, you see, they basically take all this data and they do some analysis on this data, saying that if the index, for example, moved 10%, how much has the stock moved? Has it moved 15%? Then they would say that the stock is moving at 15%, index is moving at 10%. So 15 divided by 10, the beta is 1.5 times. So if the stock market goes up by, say, 1, then the stock will go up by 1.5. That kind of a logic. I mean, these are statistical logic that is known as beta. There are things that is known as alpha. Alpha is very simple again. I'm just trying to make it very simple. Of course, we can talk for days about these concepts also. But let us say alpha. Alpha is a concept, basically means that, that the bank rate or the risk-free rate in our country is about, say, 6%. That's what you earn in deposits, right? So from that point of view, if you were to look at what is the stock return, or what is the return that the stock has given us in 1 year, and let's say the stock has given us 20%, and the interest rate that we can earn is, say, 6%. Then we say that 20 minus 6, 14% is the alpha, or this is how much extra return over the risk-free return this particular stock is generating. So these are some statistical measures. So what happens is, then we make a basket of all these stocks which are having excess alpha or which have a high beta. But remember, high beta falls also faster. Things like that. Then there comes another factor of size. Obviously, the smaller companies are more nimble-footed, and there is a lot more action happening on the smaller companies because their growth rate is likely to be that much faster. So, the larger companies, it will, a 10% move for a very, very large company will take a much longer time, versus a 50% move for a smaller company could be so much more easier. So size also makes a very big difference when we are investing. Okay. So as you can see, there are three ways. Okay, 3 ways of investing into these factor strategies. So one way is the DIY way, which you just saw, which came up on your screen a while ago. So now, how do you do DIY? I mean, do it yourself. How does it actually happen? See, if you recall, I said this particular basket or this portfolio of stocks has been created by an index, by an exchange. Sorry. So when the exchange has created some portfolio, we'll give you a lot of names and as we move along. But let us, for example, say ABCD, or that is the name of the basket that the exchange has created. Okay. Now, if you want to know what are the stocks included in this exchange, it's very simple, and it just comes in front of you. Can we show an example? Can we in the background go to the NSE website, and can we just pick up a particular factor-based product and show the portfolio there, right? Whenever you are ready, put that up on the screen. Okay. So think about it this way. Let's start from the beginning again. Little complex. Once you get the hang of it, then it's a beautiful idea. I mean, it's like your same old mutual fund, but far more, efficient, professionally managed. and great performance and all of that. And I think going forward, that's going to be the way forward. In the next 3 or 4 years, you'll see a lot of conversation happening on this thing, which is known as factor or passive investing. Okay, so one way is you look at the index, whatever the exchange has created, you see the companies that they have included in them, and then you just duplicate, copy paste. You just buy it in your own portfolio, but then you have to do it yourself, right? So that's one way of doing it. The other way of doing it is obviously doing it through a ETF, which is known as an exchange traded fund. So exchange traded fund, what does that mean? It means that the fund manager, our mutual funds, the mutual funds that you are aware of, all the mutual fund companies, they would pick up that index and they would sort of see, now that index on its own is not an investable vehicle, right? Well, that index has got a list of, let's say, 20 companies. So you have to go and copy those 20 companies and buy them all in your demat account, right? But what the mutual fund does for you is he makes a fund out of it. So he says that my fund, I will on your behalf invest in these companies. So they are in effect giving you a kind of a wrapper. So mutual fund basically makes a wrapper. So like a toffee which is there and then there's a wrapper around it. So mutual fund basically does that, saying that now this wrapper is very easy and convenient for everybody. Whoever wants to invest, please invest in this little wrapper. That's what a mutual fund does. Now the difference is mutual fund can have a fund but which we invest through the method that we've been investing, writing a check or doing an electronic transfer. Or what the mutual fund does is they go one step further and say, listen, you don't want all this hassle about writing checks and doing all this paperwork and doing any procedure yourself. You want a one-click operation, go to the stock market, click a button and buy your fund. And therefore, the stock market will provide you something known as an exchange-traded fund, a fund that is traded on the exchange. Very simple. So they'll make an ETF and you go and buy this ETF. So it's the same index. Can you have the slide back if you're not ready with the NSE? Okay. So like I said, there are three things that are happening. So 3 ways to participate, right? DIY, you go to the exchange, which we will just show you in a moment. So look at the index, copy those stocks, or forget it, don't want to do all that hassle. Just click a single, hit a single button through your broker app or which happens on your demat. Just go there and buy the ETF of that particular. See, now we have to get used to the word index, right? Because we don't call it a basket. The more sophisticated word is an index. So when you have a basket of stocks which are following a particular formula, it is known as an index, right? So this is the index that we are buying through our broker. It's known as the ETF. And if you don't want to do it, and if you don't mutual fund distributor, we buy this particular fund. If you have the NSE ready and if you can show us, that'll be nice. Otherwise, let's move forward. All right, okay. So here are some examples, okay? There is an index now, for example, which is, remember those 4 or 5 factors that I showed you? Can you just take us back 2, 3 slides to see that summary of all the slides? Yeah, this one. So I might want to come back to this slide off and on. Now, the first factor here is momentum, right? So now what we are going to do is we are going to look at that momentum basket, or what we know as a momentum index, okay? Now, bring me to that slide. Okay, so there is an index called Nifty 200 Momentum 30. Now, what this means is there is an index which is known as Nifty 200. Okay, some of you may be aware of it. See, the typical index that we are all aware about is the Sensex, because we keep talking about the Sensex, 80,000 ho gaya, 82,000 ho gaya. The other one some people talk about is Nifty, which is at 24,000, 25,000. We keep talking about it. But there are a lot of other indices. Okay, so there is an index called Nifty 200. Achha. Now, what this particular index has done is, out of those 200, based on certain formulas, based on certain factors, they have made an index, a new index called Nifty 200 Momentum 30 Index. So, which means out of the top 200 stocks, the exchange picks up these 30 stocks. The mutual fund makes a wrapper around it, okay, and we can invest in that. Now, why should we do this thing? The answer is there in your screen. And if you can just sort of highlight this thing somewhere, that well, I think my pen is also working, functional. 1 second. Yes, I got. Why we should invest in this is, look at this. I mean, this is huge, right? The kind of return that we've got here is 52%. So this index, this particular factor-based strategy has generated 52% versus the 32% that has been created by the index. Okay, yeah, we got it. So that's what I was just trying to tick on it. Okay, so look at the difference. The Nifty 200 index has done 32%, and this, call it automated portfolio, call it AI based portfolio, call it, I mean, it's not really AI based, but the transactions will happen almost automatically, because the moment you say I want to buy 1 unit of this index, automatically you have invested in 30 stocks. Okay, and then look at the kind of performance, huge outperformance, right? And even as an SIP over the last 5 years, has done absolutely like a mind-blowing performance. Nifty 50's average return has been 13%, versus this SIP has generated about 19%. So what this means is, just in a 5-year period, if we were to do a 10,000 SIP in Nifty, our value would be 8.5 lakhs, versus in this particular index, it was going to be 10 lakhs. So such a huge difference with such a small money. So if you are doing 1 lakh SIP, the difference will not be 1.5 lakhs, it will be 15 lakhs difference. And if you are doing much more, then the difference keeps widening as we move along. Let's show you some more examples. Okay. Look at this. This is another index. Now there are so many index. Can you show us a NSE based index? Yeah, that's very interesting. If you can show us one of the, if you just take us to NSE website and show us that. Just wait a minute, friend. This is very interesting. What you're going to see, and this is, by the way, public data. Okay. Now here, this is the same index that we were talking about, right? Where we are saying that this is Nifty 200 Momentum 30 wala index. Okay. Now look at this index. The index is here. Okay. This is where the index is. We are saying that this is the index. Okay. And what is happening is, okay, this is the index for you people. Okay, now this is a drop down, right? Yeah, can you show us the drop down also, please? Yeah. See, there are so many, I mean, there are hundreds of them, by the way. Oh, I'm just letting the cat out of the bag. There are hundreds of indexes. How many do you know of? We know Sensex, we know Nifty, some of us know Bank Nifty. Uske aage, generally, we don't know. We know maybe small cap index, mid cap index. But just look at the number of indexes. There are so many of them. We'll talk about that also in a bit. Okay, escape this, please. Escape this. But look at it. Now NSE has made this index. Okay, it's called Nifty Momentum 200. These are the stocks. Very simple. Now you can do a DIY. You can copy this into your own Demat account, and then the performance is already there. The historical performance we have just shown you. So just imagine how granular this investment is happening. How easy are they making this investment? So anybody having absolutely no knowledge of finance also can actually participate into this, can actually get into this factor investing. Just understand only one thing: what strategy am I getting into? See, it was very simple. We could always invest in Nifty 50 and mid cap and small cap kind of funds, right? So this is something which is a step better. He's telling you, here's a basket, here's an index which has been curated, which has been scientifically created for you. Just come here, invest your money, enjoy. And then everything else, the exchange and the fund manager will do. Super easy, super efficient. And also, by the way, it is that much more cheaper versus the standard mutual fund. So we'll come to that. Sure, let's move forward. So this is the first important factor, okay, if you like, that is the momentum. Now we are going into, again, go back to that slide so that people have a link of what we are talking about. Okay, so we spoke about momentum, right? Now we are going to speak about value. Sorry, we're talking about statistical. Okay, got it. So come back. Okay, now this is basically, I don't want to get too complicated into this, but this is just to tell you that alpha is the excess return that has been generated on the risk-free, right? Risk-free meaning fixed deposit ka 6% mila, and if a fund or if a portfolio or if a basket of stocks gives me a return of say 15%, then we would say the alpha is 15 minus 6, 9% is the alpha or the additional return for that I'm getting based on this investment, right? So there is a alpha mathematically or statistically calculated index banaya hai of 50 stocks out of the top 300 stocks of the market. Look at the return. It's done 55%, okay? And versus if you compare this with the Nifty 200 return, it's about 32%. Can you just move your cursor there so everyone can see that? Yeah, 55% versus 32%. Now, by the way, this is Nifty 200. The Nifty 50 or Sensex had done a little lesser, about 25, 26%. So just think about it. Here is a very objective. Now, this is very important, okay? There's something very important that I'm making a statement, which is very, very crucial. Here is a portfolio which has got zero human intervention, zero human bias. Once the index has been created, once the basket has been created, nobody interferes with it. And then when investors like you and me invest in this, the basket or the group of portfolio, the formula on the basis of which this is made actually generates the return, which is much more than what fund managers and what mutual funds are doing. So does it mean that mutual funds are doing a bad job? Absolutely not. They are doing a fabulous job anyways. But here is something, with the use of technology, we can go 2 steps further. Not 2 steps, maybe 20 steps further. But it's amazing. It's a jaw-dropping experience that we've had. We'll show you some more data as we move. But once the portfolio is made, it just starts moving on its own. Come back. So very interesting. This is the other factor, which is the statistical factor. Let's move. Okay, this is valuation. This is a very fundamental oriented factor. This one is using, like it says, it uses metrics like price to earnings, price to book. These are some, ratios that we see in the balance sheet of companies. Very, very ordinary and everyday work. But here, this strategy has also done 34% versus the index having given you 25% return. So this strategy is also outperformed the index. See, why are we talking in terms of outperforming of the index? Why are we comparing again and again with the index? Why are we doing that? Because whether it's a mutual fund, whether it's a portfolio manager, whether it is any other small case, anything, we always want to have a performance comparison. We want to have a benchmark. What are you benchmarking against? So, for example, if we say that here is a basket of stocks and this has got benchmarked against a Nifty or a Nifty 200, then it gives us an effective comparison, right? That's the reason we do this thing. So we say that on one side, here's the index, Nifty 50, and here is a fund. The fund is comprised of companies from this Nifty 50. So if Nifty has done 20% and this has done 40% or 35%, then that means this basket of stocks or this stock selection or company selection has been far more superior, far more efficient than the index. Because otherwise, you see, this is also kind of borrowed from age-old wisdom and theory, saying that the market is more intelligent than everybody put together. So what some of the gurus of investment you would say is that you invest in the index. Forget about everything else. It has different companies, different sectors. The index will always generally beat human beings. But that's not really been the case in the last so many years, because human beings are, of course, very, very smart and intelligent. And we are in India. We have the greatest advantage in that in this area of intelligence. I think we have a lot of intelligent people, and that's good for all of us, right? So from that point of view, we've always had funds that have actually beaten the index. But now here is something very interesting. See, mutual fund managers are also beating the index. But these things which are kind of basket is made, फिर कोई इसमें interfere नहीं कर रहा है, these are also beating. So therefore, they really become a compelling case for us to consider, which is why we're talking about all this. Okay, come back. Very nice. So now let's move forward. Let's go to the next factor. Okay. This is quality. Again, this is also another very fundamental sort of factor. Here, the difference between this portfolio and Nifty 200 has not been too large. But we have to also think about it this way. That in the last month or so, in the month of October of 2024, the broad markets itself have fallen. And they have fallen quite dramatically. I mean, the indices are all down by about 8 to 10%. And stocks within those indices are down even further. So, which is why now at this time when we are speaking on the 9th of November, there is not so much of a variation in performance, but there just a month back and there was a huge gap in performance. Let's move forward. Okay, this is about the size. This is very interesting. See, when we talk in terms of total Nifty, there are thousands of companies listed. Okay, but the important ones are the 750 companies, which are the top 750 companies. So, what top 750 may say, the top 50 is Nifty, and then you have next Nifty, and then you have the mid caps, and then the small caps, etc. So, the thing is, the top 200 are of course, the absolute blue chips or the marquee companies which actually are representative of the future of India, right? But that 550 companies below the top 200, which is company number 201 to company number 750, that is the future India. That is where there is galloping performance happening. These are small, but then small means they are not so small that they are fly by night. Small also means they are like 1,000, 2,000 crore companies. ऐसा नहीं है कि these companies are like 20 crore companies or 10 crores who might just disappear. Very, very stable companies, not bad. But these fluctuate more, and the growth that is happening in these companies is phenomenal. So there are buckets that invest here also. Okay. So this was all about factor and what factor does for you. And now we get into a little bit of academics, for some of you who might be interested in more academics. Okay, before that, just a very simple thing. It's a nice thing, again, as usual, to diversify. We invest in stocks, we invest in ULIPs, we invest in mutual funds, and we might be investing in factors also going forward. Okay, and we'll show you data which actually shows that there is a huge amount of preference by investors in this category. Why? Because it's very simple. It's just so easy. Click a button. Nobody needs to know anything about anything, and you still have a great investment journey. Move on, please. Okay, move on, please. Okay, so now this is very, very interesting. Okay, now you'll have to follow this. Now there's a lot of information and material on this picture, but we're not going to go through all of that. We're just going to follow and do some important pictures. We're just going to stay with me. I'll just take you through this. Just a minute. I'll just get my pen ready. Yeah. Okay. So what's happening is this is the exchange which I spoke to you about. So here's the exchange, and the exchange does what? They create the index. Okay, so look at this. This is the originator. The originator is your NSE and BSE. They are creating an index. Now, you've all heard about Nifty index, Sensex index. That is known as a broad market index. Then there is a sector index. For example, auto, pharma, these are known as sector indices. Real estate, for example, is a sector index, right? But what is a thematic then? Thematic could be housing. So this is a very nice way of understanding. Real estate is a sector, housing is a theme. Because when you talk about housing, in housing you will have cement company also, you will have ceramic company also, you will have real estate developers also, you will have all of them who form the part of housing as a theme. But as a sector, if I look at it, then if I look at real estate developers, then they're only going to be real estate developers. Or if I look at the theme of, let's say, ceramics and ancillary companies, then you will have ceramics and plumbing and fitting and manufacturers and those vendors, that little section. So therefore there's a difference between sector and theme. So far, for the last 20 odd minutes, we've been talking about strategy, which is the most important area to think about. This momentum and all of that, it all falls under this strategy. So it's very interesting. NSE, BSE, they have made strategy indices, and a lot of them. So then we'll come to that again. So in terms of products, then these mutual fund, as you can see here, mutual funds, they make these wrappers for us, right? Because how do you really invest? You can, we've shown here, you can just do as an investor, you can just do a copy paste, look at these things from the NSE website, do a copy paste. Or otherwise, go through these mutual funds and basically buy the mutual funds the way you buy. And if you wanted to buy from the exchange, then we go to ETF. Little complex. I don't want to spend too much time on this, but this is just so that you get a sense of how much development is happening under the hood in this space. Okay, let's move to the next. Okay, now look at this. These are indices. Okay, you might think, how many indices are there in India? 181 as on 22nd October. Can you imagine that, friends? 181 indices. How many do we know? Sensex, Nifty, Bank Nifty, mid cap, small cap. Achha, some of us are more connected with the stock market. So they'll know auto index, pharma index, metal index, commodity index. But there are 181 different indices. Achha, broad market. Broad market means auto, pharma, Nifty, Bank Nifty, etc. That itself is 37. Sector, we have some 40 indices. Themes, we have 47 themes. And we have 42 different strategies. Well, imagine the amount of money you need to invest on this. But there are 42 different strategies. Now, can you just take me to the Google Sheet very quickly? I want to show something. Within this 42 strategy also, how much variety and variation is there. You'll be amazed. We'll just show you. We've done so much of research in this space. It's very interesting. Can you show me the Google Sheet, please? Yeah. Can you go to number two? Number 2, indices universe. Yeah, so this is what we already saw, right? Now look at this. Can you just zoom up this area, please? This area on the right. The strategy further breakup. So look at this. 42 of these strategies available. Look at how they are broken up. There are, if you wanted to, let's say, do a strategy, if you just wanted to do a quality-based fundamental strategy, there are 13 strategies. There are 13, there are 13 indices on just purely fundamentals and quality. If you just wanted to be very aggressive, ride the momentum, I want to only invest in the best, then there are 5 strategies for that. Statistically, there are 6 strategies. If you wanted to have a mix and match of indices, then you have 4 strategies there. You want, I want indice in US dollars terms. So Nifty in US dollar terms, whether we are making money or not. If I want to invest in that sense, it's not a US dollar investment, but this entire index is converted to dollars. So we invest from that point of view. Then you have combinations of fundamental and momentum, fundamentals and statistics. I mean, and this is just an area which is just growing. And every few days, we are seeing more and more strategies come up. We are seeing more and more, intelligent portfolio creation that is happening. And this is all up for us to consume. Okay. Let's move forward. Yeah. So this is just, again, some data which I'm providing you. Now, out of, by the way, this is very interesting. Out of the 181 indices that we have, 120 indices, abhi tak kuch kaam hi nahi hua. I mean, in the sense, indice is made. You can use that index, invest in that. But the problem is that we don't have a product. And there are about 170 products ready by the 43 mutual funds. And not all these products are only in, index funds. There is a lot of opportunity for us, for mutual funds, for everybody. Okay, once again, we just want to show you a performance comparison to so that it becomes very, very clear that we are not discarding mutual fund. They've done a fabulous job, but let's just look at this comparison. This is very interesting and you will like it, okay? So now this is all happening across categories, okay? So the first category, the first section, can you highlight row number 2 to row number 8? Okay, yes. So this is the large cap area, or the biggest companies of the market. So in this space, what I want you to do is now that we've understood we are selecting the top, the 8 rows, can you just select these 5 numbers from 37 to 52? Yeah, can you just click on 37 and select the 5? No, not all of them, just the 1 year last one. Yeah, and can you show us the average performance? The sum is 201. Can you show the average? So average is 40.31. What this means, friends, is that these particular strategies, which are large cap strategies, market strategies, these strategies in the last 1 year have generated a return of 41%. Okay. And compared to that, large cap mutual funds, look at that return. 1 year. Can you just do the same thing on an average there? Is 40%. So it's neck to neck. Huh? I mean, this is of course large caps. I mean, this is again very, very different. So if he didn't want to do, I mean, mutual funds, and if he wanted to do ETFs, look at how this is going to aggressively replace mutual funds in few years to come. And on its own, they are generating. Now, nobody is intervening. Again, I'm saying this thing. The fund manager does not intervene in this strategy. They are based on formula. The formula is refreshed from time to time, but that is all that is happening. So the formula is getting refreshed once in a half year, or the formula might be getting refreshed once in a quarter, but that is all that is happening. Now look at the next category. This is the mid cap, large and mid cap category. See the average return here, 40, 60, what is the average return here? 58% is the average return here. And funds have also done, they're not back, they're not behind, they're not lagging behind. They've also done about 56 odd percent. Okay, but 56 to 58, they're doing very well. Individually, I mean, look at the highest guy. This particular enhanced value fund has done 68%, which is, I mean, the highest return generated in this category has been by a non-interfering, non-subjective, a very objective product. And these are some of the, on the right, you see the fund names. These are some of the funds that they're the best performing currently on the last 1 year time frame in their category. So like that, we just basically move down, go down, please. Okay. In the mid cap, the MF has of course done better, and then we don't have too many products here. So there's only one product here. And in the lower section, I mean, a lot of work is happening here. So we don't have data, good enough data here to show. But the whole point right here to understand is there is a automated mechanism coming even for doing our investments. And it's coming in a very, very large format. Come back to the presentation, please. Okay, now this is very interesting. Okay, this is almost towards the end. Now, how large? Now, there's too much happening on this slide. We'll make it very simple for you. Okay, let me just activate my pen again, and just a second, friends. Okay, here. So now, let's just say the US market. Okay, the US market cap is 50 trillion today. Okay, here is 50 trillion. Sorry for the markings, not very nice, but 50 trillion. Okay. So out of the 50 trillion US market, the market controlled by USA through mutual funds is 26 trillion, as you can see this number here. And out of 26 trillion, 9 trillion is ETF. So 1/3 of the market there is all based on these strategies and indices, okay, ETF. So which means after so many years also, it's not like active fund management is gone. They are neck to neck, but low cost, efficiency, automation, all of that. I mean, this is a huge area. Now look at our market. Okay, we have not even scratched the surface. We are not even like more than 2 or 3 years old. We don't even have data which is credible data, which is 3-year-old data, which is why we were talking 1 year data. Okay, but the speed at which it is happening, we'll be way ahead of America. Just wait for another 3-4 years. Okay, our market, Indian market, where are we? We are at about $4 trillion right now. As we speak, started 3.5 to 4 trillion. Abhi thoda sa correction ho gaya, so we are down a little bit, but say 3.5 to 4 trillion. Our mutual fund market is 60 lakh crores as on data is as on March. Please note, this is 6-month-old data. We don't have the latest figure. So as on March 60, right now it will be what? 70 lakh crores? 64, 65, we are in September. It went up to a little bit more, to about maybe 68, 69. But then with the correction, we're down to about 64. 64, 65 lakh crore right now. But doesn't matter. Let's go with the March number. 60 lakh crores. But out of 60 lakh crores, look at the interesting bit. 7 lakh crores is by ETFs. How much is that? Is more than 10%. US after so many years is 30%. We are at about 10% plus now already. And this is not even like I said, we don't even have 3-year data. Oh, it's by the way, we have this AUM written in September 24 year. We are at 68 lakh crores out of. So 68 lakh crores, and if you say 10, 11% of that, so this 7 lakhs is very easily become about 8 lakh crores as we speak. So at a galloping pace, this is happening. And we don't want anybody to be left behind. We will also be doing this. And there are lots of ways in which we can participate into this factor investing. But from an academic point of view, let's just finish this presentation and then we'll move on to Q&A. Can we move on, please? Okay, I'm tracking. Okay, quickly show us this thing. Okay, just go to the next one first. Okay. So, I mean, this is just to say that, all bloggers and all influencers, everybody's talking about it in a very big way. There are lots of YouTube videos that you can see. We'll talk about that jump in growth. We've already shown that, but we'll talk about it. Move on, please. Okay. No, this is not about. Okay. I mean, okay. Let this be. Can you go back to the Google sheet, please? And show us that growth in assets. See, this is again very interesting. India, basically, Nippon Mutual Fund is one of the largest players in this space of creating wrappers and products for doing ETFs. Okay, so we'll just show you how these guys are moving. Yeah, yeah. Okay, if you can just make it a little. Okay, doesn't matter. Do you have a? Okay, you might have to make another column. Huh? Just make another column here in E. Simply divide B by D. So what I'm trying to do is October 24. This is the figure. Column B is actually October 24. So just divide B by D. B divide by D. Okay, thanks. Got it. Okay, just remove all these decimals so that we have single numbers, or just keep two decimals. Just keep two decimals, okay? So we are able to see it properly. Okay, friends, have a look at this. What this basically means is, in this first category, the index category, the BSE Sensex, it has grown. The assets, okay? Assets mean the number of, the amount of money people have invested, which is you, me, and everybody, okay? Now, these are institutions doing it, so don't get real swayed. This is a very scary number. Last year, 1,300 crores were invested in this BSE Sensex. Today, there is 11,500, 9 times growth in 1 year. Okay, but this is an outlier. What the interesting thing to see is all the other strategies here. For example, look at consumption. Consumption means FMCG and all that. It is doubled in 1 year. This is not the return. This is the amount of money invested, about the interest level. So from 49 crores, can you just show 49? From 49 has become 118 now. Okay, like that. Let's just, for example, take an example of, let's say, look at this PSU Bank Bees. 1,400 crores has become 2,400 crores. Look at the jump that is happening. Look at the one below that, Nifty Auto. How many people have invested in the automobile sector? From 65 crores to 231 sector. See, very small numbers right now. Okay, but it's a matter of time. It's a matter of time where this will explode. Okay, by the way, these huge numbers that you see in BSE Sensex and Nifty, why this? Can you just highlight this 14,000 and 34,000, and this BSE Sensex where 13 to 11,000 you were? Friends, this is also because of the employee provident fund money. So a lot of money from the employee provident fund, from LIC and all, a large part of insurance and long-term retirement money also has been mandated to invest a certain amount in the stock market. And within the stock market, they have to get into the top line stocks. So top line stocks basically means the index stocks, which is why you see such a huge jump in the index itself. But the interesting thing is all the other numbers below. There is hardly anybody, everybody's at 1.7, 1.8, 2 plus, which means the interest has doubled. The amount of money invested here is doubled in 1 year's time. And this is going to follow an exponential scale. So when we speak, let's say in October, November, or towards the end of 25, these numbers would have doubled or tripled again. So that is the speed at which things are happening in this space, So which is what we wanted to share with you all. Everything about factor investing. Great new way to invest.